Good afternoon, everyone. My name's Thea Davies and I'm Special Counsel at Barry Nielsen and a board member of Flipper. Flipper welcomes this lunchtime Mr. Peter Skinner, who is the Director of PGS Superannuation Consulting, to present today's lunchtime webinar. The topic today is invalidity pensions and other superannuation splitting issues in family law. Firstly, in relation to Peter, as a Director of PGS Superannuation Consulting Proprietary Limited, Peter values superannuation interests and provides strategic advice for family law purposes. This includes valuations of Commonwealth superannuation schemes and some state government schemes, defined benefit superannuation schemes from the private sector, semi-government organisations and local councils. Peter is regularly appointed as a single expert witness and has appeared in court on many occasions. Peter's extensive experience in the area of superannuation includes spending various years in defence, with a vast number of those years in executive positions, including responsibility for defence budgets and superannuation. For part of this period, he was the Secretary of the Defence Force Retirement and Death Benefits Scheme, or DFRDB, review panel that resulted in the establishment of the Military Super Scheme. He has also been the Deputy Commissioner of Superannuation and the Deputy Chief Executive Officer of ComSuper. Peter has also provided consultancy services to ComSuper. He has also been placed in the role as a trustee of Military Super, Army Health Benefits Association, and also a member and acting chair of the DFRDB Authority. Peter's experience has given him a depth and in-depth understanding of all aspects of the family law valuation methodology and Commonwealth Defined Benefit Scheme, namely the DFRDB, Public Sector Scheme, Commonwealth Superannuation Scheme and Military Super. Flipper again welcomes Mr. Skinner to commence his presentation on pensions and other splitting issues in family law. If I could just ask everyone to remember to put their, remain on mute and keep your videos off. And what Peter has requested is if anyone's got any questions, please feel free to type them into the question and answer panel during the course of the presentation. He's more than welcome to have an interactive presentation with everyone. Thank you very much. And thank you, Peter, for coming.
Well, thank you, Thea, for that introduction. Okay, and thank you, everyone, for joining in this webinar. Can I have the clicker, please? Okay, so that's just has covered that. So, oops. So I'm going to mention very briefly the new ATO discovery process. And whilst the main talk is about military superannuation and invalidity, the same principles apply to any defined benefit scheme that incorporates a pension and a compensation element. So it does have wider view, wider outline. So now this new feature has come in only from the 1st of April 2022, and it's quite revolutionary in terms of the discovery process. And it allows superannuation information to be shared, and the process makes it much harder for parties to hide the superannuation assets. Basically, it's done all through the courts, and it's the court registries that interact with the Commissioner. The steps are that the superannuation information form is completed electronically. The courts will verify that there are ongoing proceedings. The ATO has given themselves 5 business days to respond, which is very encouraging, and it's expected that all distribution will be electronically. The important thing to remember, though, is the information you get back is what's held in the ATO database. It's not reflecting the current position, but it's a discovery process, and that might then lead on to acquiring a Form 6 from the relevant superannuation interests. So there are 3 possibilities of the outcome. The first is that the ATO provides confirmation of the name and confirmation of the super fund. The other possibility is that the ATO will confirm the name but no superannuation. And the third possibility is that both the name and other superannuation records will be discovered in that process. It's a pretty intuitive process, really. I think that for practitioners, it's just important to have a look at the employment history of the person, and then align that employment history with what the superannuation has done. If they've been employed in the one industry and in the one fund, then there's no need to avail yourself of this service. But if the person has moved in and out of jobs and there is an obvious lack of continuity in the superannuation records, then this provides a very easy and expedient way of discovering the superannuation. Now, I'm sure that I don't need to talk about the complexities of Commonwealth superannuation schemes. That was one of the main reasons that we don't have any schemes in existence at the moment. They've all been closed down. But it is quite challenging when you first come across it. The most important thing is, as far as a practitioner is concerned, is that you can't write a base amount greater than the family law value, and the family law value pays no adherence or relativity to the value in the member statement. If by chance you do write an order where the base amount is greater than the family law value, then the interest is not split at that time. It must wait until the person is actually retired. So there's no separate interest created, and that brings all sorts of unintended consequences. The second thing is that the non-member spouse doesn't receive the base amount. He or she will receive the higher of the family law value or the scheme value, and the scheme value is generally higher by about 5 to 10%. So given that overall complexity, then when you start integrating invalidity as well, then it becomes quite complex indeed. Now, the superannuation splitting process has been remarkably successful. It was introduced in December 2002, and it's withstood challenges. The full court cases have given rise to clarification along the way, but on the whole, it's been remarkably successful. But the sole exception has been on invalidity pensions. And I guess the complexity and the issues involved is illustrated by the fact that in July 2016, Military Super closed and 2 schemes came out of Military Super, one covering ordinary superannuation as an accumulation scheme called ADF Super, and the other one for compensation. So by splitting the superannuation into the 2 component parts, then the issues that we're going to be dealing with today has have been obviated. The important thing too is the Family Law Act is silent on how to treat invalidity pensions when the invalidity pension is a composite of a compensation and retirement element. The excitement on invalidity pensions arises because of their high values. Most have a lump sum of up to 400,000, and the pensions can be as high as 2 million. I've seen some even higher. Now, any split of an invalidity pension always involves both the lump sum and the pension, and it's not possible to write an order to say, I want just to split the lump sum component of this pension. It's one scheme, and the one set of orders apply to both components. The other aspect is that the family law value, this high value, shows an explosive increase. So the day before, it might only be valued at, say, 200,000, and the next day it's valued at 1.5 million. So it's a dramatic increase. And generally speaking, the younger the person, the higher the dramatic increase is. It can be as high as 35 times the day before. The closer the person gets to retirement, then it might only be 50%, 40% higher than the day before. So the issue is, how do we treat this increase? And as what caused the increase? Now, in this talk, I'm going to always assume at least a two-pooled approach. There may be circumstances where you want to have a three-pooled approach, which would involve ordinary superannuation assets, the invalidity pool, and then normal non-superannuation assets. But typically, the traditional approach is that practitioners are given advice from an expert that say either 100% goes into the property pool or 0%. It's sort of an on or off switch. And of course, it depends on the party that you represent as to whether it's 0 or 100%. The other thing that my 20 years in this job has shown to me is that one person can be arguing 100% one day and in exactly the same circumstances, but representing the other party, it's 0% the next day, but that's not unknown in family law. The fact is, though, that the entirety of the invalidity pension is splittable. So what I'm hoping that you'll take out from this presentation is a mechanism that reflects the unique set of circumstances in each case. And that is, these circumstances are that they would reflect the amount of compensation, it reflects the amount contributed prior to the compensation event, and importantly, each will be different and each will just depend on the circumstances of the case. Well, from 2002 to 2012, in other words, the first 10 years of the superannuation regime, the splitting was really hit and miss. It was highly generalised and probably reflects the lack of supporting quantification and the lack of evidence that was tended to it, which really left the judge no other avenue but to give a generalised outcome. So you'll see there in the slides that around 15%, 10%, 15% was considered to be normal, despite the fact that in each of these cases, the circumstances are going to differ, and it really calls into question whether a uniform percentage is appropriate. Well, that changed really with the decision of Attabelli, which was handed down in December 2012. And it was really the first comprehensive consideration of family law and invalidity pensions. In this case, 2/3 of the asset pools in superannuation. So very, very important. In fact, the whole case really revolved around the treatment of this New South Wales police officer's pension. They had 3 children, and the most important paragraph and the most important conclusion is at paras 55 and 56, where Attabelli states that once it's accepted that a sizable component of the value of the pension merely compensates for the income she's no longer earning, then there can be no logical conclusion to having claimed a contribution to this. The wife's, again in this case, there was no quantification, but the wife was claiming 15%, and the judge accepted that 15% looked fair and reasonable. But I think the important thing is that the statement that was made that the lack of contribution to the compensation component, that's the key aspect. Well, 4 years later, we had the full court case of Welch and Abney. Now, this one was slightly different. The Attabelli case judgment was more akin to military super, because that was an income stream that had both compensation and retirement. In the full court case of Welch and Abney, that wasn't the case, but the same principles can be deduced. In this particular case, there was a total and permanent disability pension payable until the age of 65. And the ordinary superannuation was put on hold, preserved, if you like, until 65. In the original decision, the entitlement, the total and permanent disability pension entitlement, was treated in a similar manner to earnings, and it was on that basis it was sent back to a retrial by another judge. At the retrial, the amount involved, by the way, was $1 million, so it was quite a lot of money. The amount at the retrial, the compensation was excluded, but the ordinary superannuation was included. And it's that principle that I take forward. So it's important, and to just crystallise that, it's the key, it's a crunch point, and it was made easier by virtue of the fact that you had compensation as a separate entity and superannuation as a separate entity, notwithstanding it was all payable from UniSuper superannuation scheme. Now, each case is unique, and the methodology that I'm recommending reflects that. And if you take an example where a person who is, say, age 20 and retires the next day, well, you would expect intuitively that the vast majority of that income stream is, in fact, all compensation. And the opposite is when a person is 59, 1 year prior to retirement. There you would expect that very little of the income stream is compensation. And so what I'm recommending is that that the period of contribution specifically drives the outcome. Now, what is military invalidity? Well, it's a 3-tiered approach. The highest is Class A. It's interesting that Class A starts at 60%. It is not total and permanent disability. So that's an important consideration, and it does impact on another matter when we come to talk about taxation. The next level is Class B, and that's half of the Class A, 30%, and both the A and the B get a pension. Class Cs, which are for people who are dismissed invalidity through such things as an ingrown toenail or some other malady, sometimes more serious, of course, then they don't get any pension. They simply get what they would have got had they retired ordinarily. In other words, a preserved benefit. And the other important thing about the Class A and the Class B pension is that both these pensions are reviewable until the age of 55. Well, what happens if the non-member spouse pension, what happens to the pension of the non-member spouse? Now, when I say the defence member health improves, there's a two-stage process to that. The actual health of the person can improve, and a lot do. But the other thing that can happen is that another employment category can be added through going and obtaining additional qualifications. So invalidity is always assessed against what the last employment category of the person was. So they are unfit for duty for what they were doing last. If they acquire new skills, then they may no longer be fit for duty. They now may be fit for duty, and that would orchestrate perhaps a change from Class A to Class B. But when the pension is split, a separate interest is created. And that is then solidified, it's paid for life, it's subject to CPI, there's no reversionary benefits, it can't be commuted into a lump sum, but it is for the life of the non-member spouse. Whereas for the member spouse, the invalid pensioner, that's always subject to review. And that places, again, a different emphasis on the compensation component. I've covered about all those points there. The member's pension is always reduced in proportion to the split. So if the splitting order had 10% to the non-member spouse, then the member spouse would be left with a pension of 90% of what it was before the split. So it's quite straightforward. In the event of a practitioner writing a base amount order, then that base amount order is expressed as a percentage of the family law value, and that percentage is then transferred through. I think in terms of communication to all parties, it's always better to just use the percentage split. Now, the non-member spouse has additional complexities because the expectancy. So all things being equal, and exactly the same age, then the longer life expectancy for the female would mean that one person would get 48% and the other party would get 52%. Although the non-member spouse, the female in this case, is getting 48%, it is going to be paid for a longer period of time so that over her expected life expectancy, she'll be paid the same capital sum as the member spouse. So basically, the approach that I recommend is that there is a recognition of the mix, that the pension contains a mix of both ordinary superannuation and compensation. Now look, there is only one income stream. It's not divided into two. No one can say at a glance, oh, that's compensation and that's retirement. It's not that simple. You have to work it out, but it is quite easy to work out. It's not underpinned by any provision in the Family Law Act. It's really appealing to logic and rationale. And as in Welch and Abney and the judgment of Attabelli, relies on the compensation aspect being excluded. And it also reflects the new provisions in military super from 2016, creating two separate streams. So it's quite simple in concept, the approach. You take a family law value at the start of the pension, and that incorporates the explosive increase. So that's going to be quite large. Let's call it, for the sake, $1 million. And we take the family law value the day before. And let's assume that the person's contributed for about 10 years, and we'll say, for the sake of the argument, that the contribution, the family law value of the contributions the day before was 100,000. So in that case, there's a tenfold increase. So a tenfold increase would suggest the person's about 30, 33 and joined about 20. So the amount of compensation then is the difference between the two, the 1 million and the 100,000. So the amount of compensation would be 900,000. So if we express, and let's say for the sake of simplicity, the invalidity pension is $100,000. It won't be. It'll be less than that to get a family law value of 1 million. But let's just take 100,000, and then we've got 10,000. We've got 10% in compensation. So what 10% as ordinary super. So what we're saying really is that the amount that goes into the property pool should be 10% of that income, that invalidity income of 100,000. So in this case, the amount going into the property pool would be 10,000, and there would be explicit recognition that the difference between the family law value at the start and the family law value the day before is compensation. But then the big question is, well, what should be shared between the parties? And that all depends on the circumstances. And that's perhaps why the three-pooled approach might be rather attractive. Now, if you're in the fortunate position of deciding who to represent, my advice is always to represent the member. It's so much easier to argue from a position of strength rather than to have to really dredge through some other arguments. So let's have a look at some of the arguments for the non-member spouse, because it is by far the more difficult one. I'm not getting my slides to... I'll go back to the other. Yes, yes. Okay, thank you. Sorry about that. So I've got 4 points here. Period of separation, the Douglas decision, small pension tyranny, and an alternative that you may wish to consider. And just bear in mind, this is for the non-member spouse. No, we're right. Yeah. So the first one is the period of separation. So if the period of separation is substantial, then that can be an argument. So if the separation is 6 years and the member spouse has received a pension for 6 years, and that's a material amount that the member spouse has received as opposed to the non-member spouse. So quantification of the amount received since separation is certainly an issue. The next one is the Douglas decision, and this is a recent decision of the full federal court case. And again, it does impact on the general consideration of superannuation, and it aligns with the process that I'm recommending because it explicitly recognises the reviewable nature and the compensation nature of superannuation, of invalidity pensions. And what that decision said is that instead of taxing as an income, which was the case prior, it's only the funded lump sum, which is a very small element, which is now subject to tax. However, there's no impact on the non-member spouse. So the entirety of the pension could be transferred to the non-member spouse, but the amount taken home will be substantially different. The thing to remember, though, that it only affects Class A pensioners that have been classified as TPI. Now, there is no classification as TPI, but it would be a high value, 80, 90, 100% injuries that gave rise, or the 80% reflects the extent to which they can no longer work in the profession and their education. Because it always relates, the amount of tax for these people relates to how much has been contributed, then for those under 30, the tax rate is less than 1%. I've seen tax rates of less than 0.1%. For those around 50 with a pension of 156,000, you can see there that the pension, the amount has been reduced quite considerably and materially. So it's a material advantage. In fact, for that person at 50, the capitalised value of the tax savings over the remainder of his life expectancy exceeded $500,000. So it's a substantial sum. The question then relates is that given that you've got this disparity of tax treatment between the member spouse and the non-member spouse, how do you align? How do you compensate for that? Well, one way is to increase the base amount by a factor. I suggested 30% there, but it's whatever can be agreed, of course. The other argument for the non-member spouse is what I call the small pension tyranny. In the example I gave before of the $10,000 going to the non-member spouse, after life expectancy, if and I'll use the female form here, if she was to get a pension of 50% of that, then she'd be getting about 4,000, if they're at the same age, about 4,800 odd. 4,800 is not, insignificant, but you have to then look at the impact of that 4,800 against the offsetting provisions of the age pension, of perhaps child support payment. Now, if it wasn't for the invalidity pension, she could have a lump sum, and that lump sum would have been a very handy resettlement provision for paying off debts or whatever. She now has a small pension, and there are lots of cases where the pension that I've seen is materially less than the amount that I've nominated. So that is another argument. How to offset it? Well, again, how long is a piece of string? It's whatever can be negotiated. Now, there is one other alternative, and that is that right at the beginning, I mentioned before that often in invalidity matters, the benefit consists of a lump sum and a pension. Now, the member does not have to leave the lump sum in military super. He or she have always had the opportunity to transfer that to another superannuation fund. Now, it still has to be preserved till preservation age, but if the lump sum is considerable and the lump sum is going to make a substantial benefit to the non-member spouse, then there may be scope to have an agreement between the parties where the member transfers the lump sum into another complying superannuation fund, and that would then allow 100% split or whatever to be exercised on that superannuation fund, leaving just the superannuation, the military super having the invalidity pension, and therefore having perhaps even a different percentage applied to that. Now, what happens if the member dies? What is the entitlement for the non-member spouse? Well, unfortunately, there's no entitlement. Now, in this circumstance, I'm talking of situations before the orders are made. Once the orders are made, of course, the non-member spouse has a separate interest in her name. Before the orders are made, there's a period where the non-member spouse could be placed in a position of quite considerable risk if the expectation is that the benefit from any splitting order will be considerable. And there is no way that you can mitigate that risk unless you take out life insurance. Because if the member spouse dies, then there is no entitlement to any reversionary component for the non-member spouse. It doesn't go to the estate, it simply stops. Whereas the member component, it does go to the estate. So there's a second bite perhaps through the estate. But for the pension, it ceases. And so that cessation of pension is certainly a risk that you need to take into consideration. In fact, that applies to all defined benefit pensions, that they normally cease, and there's no spouse recognised by legislation once separation is incurred. So the risk is uniform for all of those. So my position is that there's no need for extremes. There's no need for 0 or 100%. A rational approach is possible, one that takes into consideration the length of the contributory service. It still gives latitude to the unique circumstances and factors into various adjustments that you can consider. It places the parties in the same position as that of the parties in Welch and Abney, and for the successor of military super. So but just bear in mind that that there's no precedent cases for military super. It hasn't been tested out in the law courts. So, but I still adhere to a rational approach, and I think the approach that I've suggested is quite acceptable. I think the other way of looking at it is that if you do place the invalidity pension into the property pool, it's akin to placing future wages into the property pool. And for the non-member spouse, that's not even a consideration. So it's certainly, it's not only the explosive increase, it's not only the reviewable nature, it's the very unique nature of why that explosive increase occurs, and if you fail to take into account what it really means. So to conclude, that the process that I've outlined works really smoothly when there's a reasonable period of contributions, 10 years plus. There, the non-member spouse gets an amount which is quite reasonable, and it doesn't really show a vast difference between the member spouse and non-member spouse. Where that vast difference occurs is when the member is very young. When the member's only served 3-4 years, sometimes even less, then you don't get very much to share because the period of contribution has been so low, has been so small. And there you really need to be creative. But I think that the facts that I've outlined and the considerations outlined hopefully will assist practitioners in their deliberations of these very challenging circumstances. So that's all I have to say.
Thank you. Thank you. Is there anyone who has any questions from any of our people listening? Okay, so this is a question from Jennifer. What Jennifer says is, it seems to me that expert advice is critical. And also ballpark, what is the cost for that?
Oh, well, it all depends, but it's going to range between 1,500 and 2,000 to get all the all the data together, all the family law valuations, and to do a report which gives a recommendation. I strongly recommend too that a joint expert be appointed in these matters, particularly if you have confidence in the expert, because it just, to have one party arguing 100% and the other party arguing 0%, it just wastes the money that you've spent on getting the single expert reports for both parties. It doesn't lead anywhere.
Okay, we've got another question. So do we get the valuation from you, but then need further advice about what component of the valuation given is put into the pool? That's the first part of the question. And then do you give that advice even if you've done the valuation in the first instance?
Yes. So it can be an exploratory valuation to see whether it's worthwhile doing further analysis. Generally speaking, I'll give some sort of commentary with the valuation, which would suggest one approach, but yeah.
And I have a question for you, Peter. You mentioned the family law valuation versus, I guess, what we call the scheme value or the fund value. And you said that can fluctuate from day to day, or, one day it could be 35 times as high as it was the other day. What's the reasoning for that?
Well, it's a family law value is discounting net present value of future income flows. So when the person has only a 4-year contribution period, they've got a long time before the age of 60, and they haven't accumulated very much. So the family law value is very small. On the other hand, the invalidity pension given assumes that they would have contributed through to the age of 60.
Right.
So it's a lot of service that is recognised in the calculation of invalidity pension. And so that family law value is very high. So you've got circumstances coming together to give a very low family law value for the very young person and a very high family law value for the same person, because they are going to get that income stream that's worked out to age 60 over the entirety of their life.
Sure.
So it's a long period of time to discount all those pension payments, so that you've got a very high value for the for it. So that's why when you get to age 59, the disparity between the family law value as a contributor and the family law value as an invalid pensioner is diminished dramatically.
Yes, yeah. And we've got another question. I may have missed this part, but how do we obtain a family law valuation? Is this directly from the fund?
No, the fund doesn't provide, CSC or the Commonwealth Superannuation Corporation does not provide family law valuations. You can You can value off a member statement, but that will only give you a family law value at the date of the member statement. If you need a family law value at a different date, which most people do, then you need to acquire a Form 6 from the trustees.
Sure. Yeah, cool. Excellent. Does anyone else have any other questions? Please type them through. Thank you everyone for listening today, and thank you very much, Peter, for attending. That was very, very insightful, and particularly on a very difficult topic of superannuation and pension funds.
Thank you.
Thank you. Thanks for joining us.
Thanks very much, everyone.